Hello everyone, and welcome to lesson 1.5. Today we're going to be talking about the indicators that I use for my own day trading system. I'm not going to cover every single indicator out there under the sun, but I am going to cover a lot of really good ones that I think will help you with your trading. So with that, let's get into the lesson. Alright, so we got a lot to cover today. So to begin, I'm just going to give you a quick foreword, quick precursor to the different indicators that I use. And then we're going to go through each of the indicators and levels that I have on my chart in detail, and I'm going to give you the theory behind why I use each of them. Before we hop into each of the indicators that I do use, I want to just give you a kind of quick word of warning about indicators in general. There are hundreds of indicators you can add to your chart. You've got RSI, you've got MACD, oscillator indicators, you've got Bollinger Bands, etc., etc., etc. The list goes on. All of these indicators, by definition, are lagging because they are calculated off past price action, okay? Indicators really don't tell you anything that's going on in that moment. For that, you need to get better at interpreting price action and volume analysis and some of the other tools that I'm going to teach you later in this course. So because of point number one, in my opinion, most indicators are either total garbage or they're just an unnecessary crutch, where you'd be better off just focusing more heavily on price action rather than having 100 different lines on your chart. However, this brings us to point number three. If you find them helpful and they increase your accuracy, use them. Please, feel free. I've told you this before and I've tried to be clear, but my system is one system. It's the one that I have used to become profitable. I think it is fairly easy to learn, fairly easy to replicate, and in my opinion, fairly robust. However, it's just one trading system. And if you think that, adding RSI or adding MACD to your rules will make you a better trader, then by all means, test that out and try to do it. Finally, before we get into each of the different indicators, I want to just say that this is not intended to be a strategy lesson. So I am going to introduce you to a lot of strategies and theory around each of these indicators, but they're really just building blocks in my larger system, and all of that will come in section 2 of this course. Okay, so let's get into the first indicator that I have on my chart, and that is the moving average. There are two primary types of moving averages that you'll interact with the most in your day trading career. The first is the simple period moving average. This is literally just a straight moving average of typically closing price for the last X periods. So if you have a 9-period SMA, it is the closing price of the last 9 candles, whatever that time frame happens to be. Then there is the exponential moving average. Exponential moving averages, or EMAs, are basically just like an SMA, except for that they have a kind of more complicated formula that we're not going to go over that weights more recent price action more heavily in the average. All that really means is that exponential moving averages tend to react to changes in the price faster than simple moving averages. And for that reason, I primarily only use EMAs, and I use on all of my charts a 9 EMA and a 20 EMA. I also then use a 40 EMA only on my 1-minute chart, because the 40 EMA on the 1 minute essentially equals out to what the 9 EMA on the 5-minute chart would be. So that just keeps me from having to kind of move my vision between my 1-minute chart and my 5-minute chart back and forth, because I mostly care about the 9 EMA for a lot of my strategies on the 5-minute, but I want to be able to see that on my execution time frame, which is a 1-minute chart. So hopefully that wasn't too confusing. The last thing that I do in terms of setup for my moving averages is I add a small green or red arrow that indicates when these two different moving averages have crossed. So if you look at this chart, the orange line is the 9 EMA and the green line is the 20 EMA. This little arrow just indicates that the 9 has now crossed under the 20. And that's really just a decent indication that trend or momentum has changed. Again, this isn't a strategy lesson, but that's just how I set up moving averages on my chart. Now that we've covered the setup of the moving average, I'll give you a little bit of the theory behind why I use it on my chart and why most people use moving averages. The goal with moving averages is to help you identify two things: momentum and trend. So again, for my system, I focus mostly on the 5-minute chart and mostly on the 9 EMA and the 20 EMA pair. But really, this concept is the same for every single time frame. In high momentum situations, the stock price will more respect the 9 EMA. So here's a quick example of this concept. You have a 5-minute chart of Meta. You can see this very large price move up here. You get a quick pullback, just barely not touching the 9 EMA, and then price continues to go up. In more mild trends, what will happen is that the price will pull back and respect the 20 EMA. So you can see basically that here. So you get this first high momentum move and then a longer consolidation period until ultimately you just barely touch the 20 EMA, which is the green line, before you get another strong move up. So during trending price action, these two moving averages will just help you identify how much momentum there is and whether or not potentially the trend is coming to an end. All right, so that's moving averages. Now let's get into the next indicator that I have on my chart, which is VWAP. VWAP stands for volume weighted average price. And as the name suggests, it is basically just a moving average, but weighted by the number of shares that were executed at that particular price. So, therefore, VWAP should be the same on all chart timeframes. You can also display it in your montage, which I show just a quick example of down here. And again, you should be able to display this somewhere on your trading system. And VWAP is important because it's utilized by large institutions. And it can kind of generally be considered a point of fair value for that time frame of the day. So large institutions obviously will want to execute buys below the VWAP, so they want to get kind of a better price than average, or they want to sell above VWAP again because that's considered basically better than the current average for that point in the day. So getting into the trading theory behind VWAP and using it intraday, I want to start with an extremely loose rule of thumb, and that is that you can kind of think of stocks that are under VWAP as being bearish or weak, and stocks that are over VWAP as being bullish or strong. The theory behind this is that VWAP, again, kind of represents a quote-unquote fair value for that point in time. And so if you're over fair value, then again, you're bullish. And if you're under fair value, then you're bearish. Again, extremely loose rule of thumb. The second thing that you can use VWAP for is to measure kind of how extended a stock is. Generally speaking, the further that you move away from VWAP, the more extended you are. And VWAP itself can act a little bit like a gravity well and pull the price back down to retest fair value later on in the day. So to show you an example of this and utilizing VWAP in trading, you can see a 5-minute chart here of Oxy. At this first circle, price has moved pretty significantly far away from VWAP for the day, right? Which is this purple line here. So you get fewer and fewer people that are willing to step in and buy the stock because it's so far above what is generally considered fair value. So what happens is price comes back down and retests fair value, and then we get this confirmation that the true value of the stock is considered higher. And so we bounce off of this fair value line and we continue moving up for the day. So that's just one example of how you can use VWAP in your trading. So moving along from VWAP, we're now going to talk about volume by price, and more specifically the indicator that I use on my chart, VPOC. So volume by price shows a histogram of volume by price instead of by time. So if you think about a little chart here, on the bottom of your chart you'll have these volume bars that represent, the volume that occurred in whatever period your chart is for. But if you put volume by price on the chart, you'll actually get little bars over here on the y-axis that show you basically where the most volume transacted at each price. The volume point of control, again, it's called VPOC typically, will show one line for the single price at which the most volume has transacted. So this is how I typically set it up over here on my charts, and I'll show you some examples of this in a second, but VPOC can be used for a couple different things. First, it can be used to identify consolidation types, which I'll show you an example of that, but we talked about it in lesson 1.2. And then second, you can use it to find kind of these larger time frame levels and identify very important support and resistance zones, which again, we talked about in lesson 1.2. Typically for myself, I'll only keep this on maybe one of my higher time frame charts because I don't actually reference it that much intraday. I mostly use it to identify larger time frame levels, and if I have to intraday, I'll look at it to identify consolidation types. So let's look at an example of that. So here's our example of VPOC, and if you can see here, we've got this consolidation zone for Tesla. So you've got a strong move up, and then we start to chop along sideways. During this choppy sideways movement, it will be very hard for you at first to kind of tell, hey, are we consolidating and kind of distributing shares and we're about to reverse and go down? Or are people trying to accumulate a larger position because we think we're going to go up for the rest of the day? Because again, you can't see this when you're sitting right here in time. So what I'll do is I'll put VPOC on my chart and I'll zoom in to this section here, and I'll see where this dark blue line, which is VPOC, falls. And you can see clearly that in this kind of channel, VPOC is falling at the bottom end. And so the most volume that is transacted has kind of gone through at the very bottom of this channel. So naturally what you can assume is that we're actually accumulating shares because otherwise most of the volume would have gone through at the top. So that's just one example of how you can use VPOC intraday. But again, I typically avoid trading in ranges like this anyways, and so I'll typically use this mostly for higher time frame levels. All right, the next indicator that we're going to go over is average true range. Average true range is more of a gut check or kind of reference point for traders rather than something that you're going to be utilizing and looking at every second of every day. The average true range is a 14-day average of a stock's true range. True range, you've got this kind of long, complicated-ish formula, but the reality, all it's trying to tell you is how far will a stock typically move in a day. So if the ATR of Ford Motor Company is 0.5 or 50 cents, then you could generally expect from the opening price for Ford to move up or down 50 cents, assuming that it kind of opened exactly where it closed the previous day. The general principle behind this, just to keep it very simple, and again, this is all a loose rule of thumb, this isn't a strategy lesson, but the general principle is that ideally you won't take a stock long if it's exceeded its ATR for the day. So if Ford has already moved 50 cents and its ATR is 50 cents, then you would say, well, why would I take it long here? Right? The most likely scenario, the average scenario, is that it won't move any further than this. So it might chop around, it might move sideways, it might go back down, but generally speaking, unless you have a really good reason to believe that it's a breakout day for that stock, you'll try to avoid trading at the extreme ranges of the ATR. The next thing that we'll talk about, I wouldn't even really consider to be an indicator, but it is something that shows up on my chart, so I want to be very clear about it. This is more just a quality of life thing that'll make your day a little bit easier so you don't have to mark these levels yourself. So in my system and in a lot of systems, there are options in your chart configuration to mark important levels from the previous day. So some of the ones that I have marked on my chart are previous day close, today's open. I mark yesterday's high, the previous day's high, and the same levels for the lows. I'll also mark pre-market high and pre-market low. These are levels that I'll go into more during my strategy lessons, but they're all important levels that you should be paying attention to, whether they're to trade off of or to take profit at. So adding these to your chart, again, just kind of takes away a little bit of extra, hassle that you have to deal with each and every morning, marking those levels individually. So to prove out why it's valuable to mark those levels on your chart, I provided just a quick example of NVIDIA. We have a 60-minute chart, and you can see that you set a high here for the previous day. The next trading day, that level gets touched literally to the penny and then rejects down. And then during that trading session, you end up closing at this black dashed line right here. And then the next trading day, you go up, you come back down, you test that level basically exactly to the penny, and then you reject and go back up. So, you can see this throughout this range. It's provided a bunch of different opportunities that you can trade against, and it's worth having those levels marked on your chart. If for no other reason than you could be aware that, hey, maybe I need to take profit here because it's likely that price will at least pull back when it hits this level. Okay, so now we are going to get into the final indicator for today, and probably the most important one, at least for my personal trading system. And these are called Camarilla pivot points. Camarilla pivot points were invented in the late 80s and became public knowledge kind of midway through the 90s and started working their way into institutions and algorithms. They were originally invented as a way to anticipate market participation, with the general idea being that you would kind of normally, on an average day, remain within these Camarilla pivot levels and revert back to the mean. So Camarilla pivots are clearly utilized by many institutions and their trading algorithms, and that's why I include them in my trading system. So if you look at a chart of the SPY over here to the right, I have pre-drawn the Camarilla pivots on here and included that study, and you can see how many times they are tested almost to the penny, essentially, and reject off of these levels. Okay? So obviously people are looking at them, and obviously institutions are using them, and so it's worth adding to our toolkit. So when we talk about Camarilla pivot points today, we're going to cover three basic things. The first is I'm going to give you just kind of a general interpretation of how you read them and their daily relationships. I'm then going to go through how you actually calculate them, which feel free to skip this part if you're not interested, but a lot of people do want to know the actual levels and the math behind it. And then three, I'll talk about the basic strategies that you can implement with them, which ultimately get pulled into my broader Confluence trading strategies. So there's a lot to cover. Let's go ahead and get into it. We'll start out first with how you generally interpret the Camarilla levels. The Camarilla pivot points break the chart into 6 main levels, and you can think of these as either breakout or reversal zones. Like all support and resistance levels, please don't expect them to hold to the penny, right? I've talked about that many times, but support and resistance should generally be thought of as zones rather than actual hard levels. As you will see, where the market opens in relation to these zones can be a really powerful indication of what will happen during that trading day. So when you see Camarilla pivot points on a chart, typically most people will focus on the third levels, the fourth levels, and then the sixth levels. Okay, so technically there's 1 through 6, but normally most people will only focus on these 6 levels here. The first zone from R3 to R4 is generally considered a reversal zone. Once you've broken through R4 for the day, that is your first breakout zone. Then R6 is considered essentially the last line of defense, and then once you break through R6, you're again in a breakout zone. Between R3 and S3, you typically want to avoid trading in this zone because you're just chopping around kind of in central value, so to speak. Now, on the bottom side, you get essentially the exact same thing, but in reverse to the top. So from S3 to S4, you're typically in a bottom reversal zone, so you don't expect price to move much further than S4. If it does break down past S4, then you are in what's called a breakdown zone, once again. S6, as we said from the top side, it's kind of your last line of defense, and then past down through S6, you're considered a breakdown again. So that's generally how you interpret these zones, and we'll go into the actual calculation of the levels next. Okay, so if you hate math, I don't blame you for skipping this slide, but please don't skip the next slide on calculations, because that one is more important to my actual trading system. But generally speaking, the Camarilla pivot points consist of 6 support and 6 resistance lines for a total of 12 different formulas that you would need to utilize. For my trading system, and for most trading systems that implement Camarilla pivot points that I've found, they only really focus on levels 3, 4, and 6 to both the top side and the bottom side. So here's all the formulas if you're interested, or if you need to kind of write custom code to have your platform calculate them if it doesn't have it as an indicator. And off to the right here is how I actually set it up in Dash Trader Pro. Okay, so you may not need to worry about exactly what the formulas are from the previous slide, but one thing you do need to consider is whether or not your pivot points are utilizing pre- and post-market highs and lows in their calculations. So in Dash Trader Pro, I can personally choose between 2 different pivot point levels, those that don't use pre-post-market data and those that do use pre-post-market data. Determining which set of cams you should focus on for that day is really very simple, and it boils down to this single rule. If there is a dramatic pre- or post-market move, then utilize the cams that include pre-post data. If there's not a dramatic move, then just utilize the cams that do not include pre-post market data. Very simple. And I'll show you a perfect example of that here on Meta. So you can see that Meta had a ginormous post-market move right here. All right. So the stock market closed here, and then you go into this gray section, which is the post and pre-market. And I think they announced earnings this day. Doesn't really matter, but you had a huge move. The next day, if you use Camarilla pivot points that do not include this pre- and post-market data, then they're essentially useless for the day. They're way down here, and price never comes anywhere near them. However, if you then switch to cams that do include this post-market move, you can see that they are calculated with those highs considered, and now they're actually useful for today. So you get a nice little rejection off of R3, and this would have provided a decent trading opportunity later in the day. So that's how you choose which set of cams you're focused on for the day. Now let's get into daily relationships between Camarilla pivot points. All right, so before we get into the kind of basic pivot point strategies, I want to discuss the daily relationships between Camarilla pivot points. And the reason for this is that when you play different strategies, they tend to work better on different types of days. And essentially you have 3 types of days that we'll focus on in relation to the previous day's cams. The first one is standard, and that's when yesterday's Camarilla range, so kind of the distance between R4 and S4, is roughly the same as today's range. Don't focus so much on whether or not it's higher or lower, just focus on kind of the distance between these 2 points is roughly the same. The second day that you'll need to focus on is the narrow day. Narrow days are very obvious, and they should be very visually obvious, but it's when, again, this distance between R4 and S4 is much tighter today than it was on the previous day. And then the last one that you want to focus on are wide cam days. And again, this is basically just the inverse of the narrow, but you'll see a much wider distance in today's range than you did in the previous day's range. Typically speaking, when you see a wide range day, you expect price action to remain within R4 and S4, or even within R3 and S3. When you see a narrow cam range, you would kind of bias yourself a little bit more towards playing a breakout day past R4 or below S4. So let me show you a few examples of that real fast. Okay, so here we've got an example from NVIDIA and an example from Apple. Both of these are 60-minute charts, so over a couple days range. You can see that the NVIDIA chart over here had a much wider cam range on this day compared to the previous day, and you gapped down here pretty heavily. So generally speaking, you would expect for NVIDIA to kind of chop sideways within the R3 to S3 range, and not really break out past that. And you can see it did that here perfectly. The following day, you actually have a very narrow cam range again, and you can see that price breaks down past R4. So again, just to recap, wide range day, expect it to be within the R3 to S3 range. Narrow range days, bias yourself towards a breakout. There's another example of this on Apple. You can see that you get kind of a much wider day here than the previous day and even the day before that. And generally speaking, you stay within the R3 to S3 range. So you'll see this pattern repeat itself over and over again. And once we get into the strategies, you'll see that you want to select specific strategies based on the type of day. All right, so before we get into the strategies, again, I want to give the disclaimer that this lesson specifically is not meant to be a strategy lesson. But these Camarilla pivot point strategies and the indicator is an important part of my Confluence Trading System. And when we get to section 2 and I go through my strategies in detail, it will be tremendously helpful for you to already understand this information. So when it comes to pivot points, specifically Camarilla pivot points, I want to cover 4 different strategies: the R3 S3 reversal, R4 S4 reversal, R4 S4 breakout, and the R6 or S6 reversal. So let's get into each of these strategies and how they are kind of traditionally traded. The first strategy that we're going to want to memorize with the Camarilla pivot points is the R3 or S3 reversal. For this strategy, you're going to want a standard or a wide range relationship to your previous day's cam levels, and you're going to want opening price to fall within the R4 to S4 range. The basic play here, and it's very straightforward, is that you're going to have price open, let's say right here, move up to R3 or maybe down to S3, form a reversal pattern, and then reject off of those levels. So off here to the right, you can see basically a perfect R3 rejection multiple different times off of Tesla. I actually played it right here for a short and covered down here at these green arrows. And then later on in the day, you actually get an S3 rejection. So I took this one long and I sold the rest of my position up here. Obviously, don't pay attention too much to this trade in terms of, obviously I could have held more, done better execution, but the point is that this is the basic strategy. Wait for price to open, form a reversal pattern off these levels, and then reject to the opposite side. The next strategy that we'll cover is going to feel very similar, and it's essentially the same thing, but this time it's a reversal off of R4 and S4. So once again, you'll want a standard or a wide range cam day in relationship to the previous day's range, and you'll want price to open within the R4 to S4 range. You'll wait for price to test these levels, form a reversal pattern, and reject off of that level. So here's an example on Apple. You can see that price opened, this is just a 15-minute chart, so price opened here, went all the way up, tagged R4, rejected, and failed for basically the entire rest of the day. And even down here at S4, you actually got this nice inverted doji hammer candle, and price rejected off of that S4 level. So that's the R4 S4 reversal. Again, very similar to the R3 S3 reversal. The third strategy that we're going to cover with the cam pivot points is the R4 or S4 breakout. This is played on days where you have a narrow cam range or perhaps just kind of a standard range. You'll want price to open either above R4 or below S4, or on very strong days and narrow ranges, it can open within the R4 to S4 range. Basically what you're trying to do here is play a continuation off of these levels. So you'll wait for R4 to kind of retest here, or you'll wait for it to break out and then retest. And you would enter on this retest of the level for an upside, or with the S4 reversal, a downside move. So again, 2 different options. Both are essentially trying to wait for it to break and then retest that level before moving higher or lower. Here's an example of that on Meta. This is a 15-minute chart. You can see that price broke down in the pre-market here and then came back up, retested S4, and then continued to fail down for the entire rest of the day. So that's the R4, S4 breakout. The final strategy that I need you to memorize for the Camarilla pivot points that'll be used later on in section 2 of this course is the R6 and S6 reversal. These reversals can be played on basically anything other than an extremely narrow day in terms of the relationships of the Camarilla pivot points. You want price to open within the R6 to S6 range. You'll have it go up, touch the levels, form a reversal pattern, and then reject back down into the middle of the cam range. Note that R6 and S6 are essentially the most extreme price ranges that you would typically see in a day. The breakout of these levels is fairly rare, and so what you're trying to do, again, is just play this reversion to the mean mentality where you're not expecting price to break out of those very often. So an example of these is on Tesla. Got a 15-minute chart here. You can see that price broke out of R4, went up, formed kind of this inverted 15-minute candle, and then reject back down. And this would have been plenty of move for you to get good partials and good profit. So that's an example of the R6, S6 reversal, and that's the final CAM strategy that we'll go over today. All right, so that brings us to the end of our lesson on indicators. As always, I hope that you found it helpful, and I want to leave you with just a couple quick closing comments. First, anything that you add to your chart, you should be able to objectively determine that this increases your accuracy. If you can't determine that, then you need to get rid of it because it's just added distraction that you, especially as a new trader, definitely do not need. Second, I'm going to discuss this in our strategy lessons, but the confluence of these indicators is what is a truly powerful tool to add to your toolkit. Each of them by themselves is totally fine, but combining them together is what is going to be truly powerful for you as a trader. And then last, if you want to use indicators outside of our system, that's totally fine. Go ahead and do it. Just make sure that you read the documentation and that you actually understand at a fundamental level what that indicator is telling you. So that wraps things up. Again, I hope you found this lesson helpful, and I'll see you in the next one. Have a good day.